today is markets at an all-time high. So how do you rejig your portfolio? I'm just going to introduce you to our founder and CEO, who's going to be taking this topic and explaining all the details from his understanding to all of you. Mr. Anil Rego is the founder and CEO and fund manager of RH PMS. He's a chartered financial analyst and has completed his MBA with specialization in finance from ICFAI. He has 7 years of extensive experience in management roles, specializing in business planning, mergers, and acquisition functions in Wipro Tech Finance Department. He is a regular panel member at various finance-related seminars and symposiums. He's also a guest lecturer on wealth management at Premier B schools, IMB, IIPM, ITM, ICFAI, and Union Bank, to name a few. He's also invited as an expert on Radio City and various other columns, and he's a regular writer in most of the important financial magazines and in India. So over to you, Mr. Anil sir, and he's going to take forward this topic. If you have any questions, please keep them towards the end of the session. You can either place them on chat or you can unmute yourself and ask them. Thank you.
Yeah, thank you, Sakina. Pretty elaborate introduction. Okay, so welcome to everyone on the chat, and with markets at an all-time high, I think it's a question in all our minds, how do I rejig my portfolio, right? And before we start, I thought let's start off with a poll in what is your view of the markets. Are markets overvalued? Yes, so Rashan, if you can run the poll. Yeah, please type in your responses. Okay, so we have three options. Yes, that it is overvalued. No, that it is not, and fairly valued.
So we'll wait for some more time, and before I close.
Yeah.
Please do that.
Yeah, so you've got a good number of responses. Okay, so maybe a minute or so if all of us can type in our response.
Hello, stop it.
Yeah, so it's interesting. I think 57% feel that the markets are overvalued. Okay. About 18% feel no, it's not undervalued, that there's still value in it, and about 25% feel that it's fairly valued, which means more or less where we should be. This is not surprising, considering that we've seen a lot of volatility. If you go back and actually look at it, markets have just crossed a high that it saw maybe a year back, and we will look at the graph of the index and see actually over the last few years the market has been almost range bound, but still when it goes into new high, considering that we've seen some bit of the pain in the recent time and a very steep rally in the short term, definitely many of us would feel that way. So before I sort of go into the future, I thought let me just capture a couple of points here. This is what a similar situation in the past had. Okay, and what do you think? Should somebody have sold? Because if you see here, somewhere in March and April, markets sort of were at a high. Okay, then it saw a very steep correction, and sort of it went and crossed the high, something like what we have seen, and it sort of saw a rally after crossing the high. Okay, and so do you think this is a situation where we should have sold? If some of us can just give in your responses on the chat. Anyone on should we have sold? Now this is okay, an interesting one. Okay, so at least one person, Hari, says we should not have. Okay, actually we should not have. I purposely did not show the index value. I purposely did not show the year. Okay, because I just wanted to, have a perspective out there. And this is how the market moved. If you remember the last, I'll go back, the last date was December. Okay, so this is where the chart continues from there. Actually, markets moved from, the Sensex moved from 6,000 to 9,000 points. There was a 50% increase in just 12 months. So at 9,000, the question is, was the index still overvalued? Okay, and if you see, again, let me refresh back. So this was November of 2005. I'll come back to the next slide. So November of 2005 was somewhere here. There was this fall that happened. Okay, and interestingly, the markets went all the way, up to 20,000. Okay, so the next 24 months saw the index move from about 9,000 to about 20,000 of the index. So my point is, just because markets actually end up crossing a high, they not necessarily are overvalued. Okay, and what you need to keep in mind also at the same time, I'll go back to some of the slides and see the ride has not been a straight line. So right from 6,000 to 9,000, there was a period where it almost went to 8,800 and came right back to 7,750. Right. So similarly, earlier also there was sort of corrections in the early in the chart. If you see here in the next chart, when index went to the 20,000 peak, okay, you found that there was a period when from almost just under 13,000, the index went right down to 9,000. Okay, so it doesn't mean that we see it in a linear way, and which is why I think even through such periods, managing risk and taking some money out may be a good thing to do. Now, this is how it actually fell. Okay, now just to refresh, when markets went up, they went up over 3 years, the period that I showed, the 12 and the 24 months. So almost like for 3 years it went up. But when the fall happened, it peaked out somewhere, a little over 21,000 of the Sensex. But the fall then came right down, okay, to 8,500. Okay, so you can see that the falls, whenever they happen, okay, can be very sharp and steep, which is why managing risk actually becomes critical. Okay, so if I've confused you sufficiently in saying that, it can keep on going on at the same time, it can also fall. Okay, I think I've done my job, because that's how markets are. Markets are very complex, and we need to study them every time. It's a sort of a different situation. Okay, and even for the experts, you're always, there's never a one clear opinion that the market gives us. It may end up, you may feel at various points that market may turn around, and the exact opposite happens. Now, this is a point that also that we need to keep in mind. The good news is that for somebody who has also stayed invested through all of this, okay, one has made 16.2% compounded, from the inception of the Sensex, and that is a humongous figure, almost like 470 times. Okay, is what one has sort of ended up seeing. Okay, so so that is something which each of us need to keep in mind, that being invested is also very important. So very rarely do we take all money out of markets. Even when we book profits, we typically, the maximum we have gone to in the past is, say, take off 50% or maybe a little over 50% of our equity holdings, because time in the market also does sort of give us returns. And if by chance one is wrong, you may just miss out some periods. Now, keep in mind that, why is it important also to be invested? Like, if I just see this chart itself, there was this period, long period where market was almost like sideways. Okay, if you see this, maybe from somewhere around 1990 or so to almost like 2004, it was sideways, and the return suddenly came, from around end of 2003 and until about that 2008 period, right? So that's how markets are, and if we miss it, and even here, if you see, if one stayed in cash, right, from 30 to 46,000, 47,000, you actually missed out a very large rally, which is why going extreme on the opposite side also and trying to actively time the market too much is not necessarily good for health. So coming back to that question of is it time to book profits, my point of view always is that we should be careful and cautious that we don't, take away money too early, because the returns come in spurts, and if we miss out those 1 or 2 years, we may just see ourselves with poor returns, and we may never be able to catch that up over a period of time. Okay, so so the question is about, I think it's about seeing how we balance it out, maybe manage risk, okay, and take money out in a phased manner as markets move up, and and we'll also look at maybe is there a different way to know what is an action that you should be taking at various points of time, okay. And now I'll just one quick moment on the economic indicators. It is interesting to note because a lot of people came back and said, yeah, markets have run up, but it is not justified. Okay, and my point to them always has been that markets are a leading indicator, and you will find that subsequently you will see that all growth numbers, etc., come back, and there are many parameters here where industrial activity has come up, and the most interesting is the PMI, the manufacturing PMI, which is basically an index of what is how bullish people are on the manufacturing side, right? We are almost at a decade high. Okay, so it's not even just a year high, we have come to closer to a decade high. So there are certain green shoots, I would say, and you would see that October there are a lot of greens out there. Okay, there are a few sectors which are red, and that is understandably so. It is air passenger traffic, air freight also is a little weak. Okay, and definitely rail passengers booked also is very weak, and this is understandable considering the pandemic. But most other sectors, I think, today sort of have come back, and you will find that certain sectors like automobiles, etc., and some spots have actually done better than where they were in February. So we could see continued economic performance, and I think that will also be triggered by falling interest rates, etc., where you could see continued economic performance. Now, how is it that we can decide on what is it that we should do? Some sort of a broad framework. I think we captured the economic cycle as seasons of the economic cycle here. Okay, and we've tried to capture it pictorially. Thanks to LPL Financial Research, I think they had done a wonderful chart. Of course, that was more for the US, so we did rework on it and customize it to Indian conditions and also expand it a bit. Okay, but broadly we have 4 phases. One is recession, recovery, mature phase of the market, and the late phase and the aging phase. Now, the recession phase basically, in this phase, the economy shrinks. You have job losses, the profits contract, which is reduced. Okay, the confidence is very weak in the market. Interest rates start falling. Commodity prices and property prices. So when I put COMM and PRP, it's commodity and property. Okay, and there is an initial stimulus from the government. This is a period when the stocks actually fall. Okay, so this is a recession period, and it's not unusual that the confidence is low. The outlook of people also is very bleak at such time, and then it's followed by an early recovery where you have continued stimulus from government, okay, you have confidence starts to pick up, okay, credit begins to expand, which means the banks and financial institutions start lending more, okay, interest start bottoming out, interest rates, property prices also start bottoming out. So you will find that the stocks would have bottomed out, at the end of the recession phase. Okay, but here you will find that markets actually in this phase, equity markets rebound. Okay, so equities actually do very well and they start early, and that's why I say they're always leading indicators, which is why when things look very bleak and markets rebound, okay, I think you need to keep an option open that we are in a phase of early recovery, and this is a phase which you can see very steep returns from the bottom, like what we've seen now. The question is, are we here? Okay, or are we still in the recession phase? Is it what they call as a dead cat bounce? Okay, is it that it's just markets have come back from a period of great impact of the economic pandemic, and they're just coming back to where they were. There may have been some latent demand in this period, and and then probably continues to head downward. So that's a question that everybody has. But if we see some of the data, which is why I captured in the previous slide, right, the economic data also has started to pick up. If I look at confidence is slowly returning. I've seen at least one NBFC say that they are significantly expanding their credit. Even if you see, some of the data, it will sort of reflect that interest rates are actually bottoming out, and we can see that it's at interest rates that we've never seen before too much. Okay, and the property prices also, we could see some green shoots that buying has started, and maybe property prices are beginning to bottom out. And so it's very much possible we are in this phase. And so if we are in this phase, then the next phase actually is a golden phase for us, where we see moderate GDP growth, okay, slow return of inflation. Inflation slowly starts picking up in the next phase. You will find that when RBI, some of the stimuluses, etc., sort of they withdraw and they normalize their policy, interest rates begin to rise. You start seeing steep but flat yield curve. Okay, so when we say what is a flat yield curve, we're basically saying that the short-term interest rates and the long-term interest rates are the same. Okay, so and they sort of remain at a flat range. Okay, so that is how it is. Heightened volatility is the other factor that can happen in this period. And if you remember the 24-month chart, there were some steep drops that we saw, right? And in the last market up move, and you see a strong property and commodities in this cycle, and stocks continue to gain, probably a very steep gains here as well. And then slowly we get off into an aging of the economic cycle, where the GDP starts slowing. You find inflation has really gone high compared to normal. Rate hikes by the RBI, is normally prevalent at this time to try and control inflation. Okay, the credit tightens, profits start to slump. Okay, and you see an inverted yield curve, which means, what are we saying? That we are saying short-term interest rates are higher than long-term interest rates, which is not normal. Normally, you expect short-term interest rates to be actually lower and long-term interest rates to be higher. In this period, you find the opposite, and this is sort of an indicator as well. And we did see some of this before, the fall that happened. And you see strong property and commodity prices continue in this late phase. Okay, so this is a point that you need to keep in mind is the market sort of move first and then possibly property move. Similarly here, property also peaks out a little later than when markets end up peaking out. So this is sort of the construct of what a normal economic cycle is. So when people say, yeah, we are not following the normal, or this time it's different, etc., my view always has been that there could be different factors for market falls and the negatives in the market, and downturns, but how the market reacts is sort of in a similar way, and it's not, at least for me, it was not unexpected that we started to see it. Of course, I must say that when we saw the pandemic trigger a market fall, we kept an option open for the market to actually fall further. We expected to rebound from March and then possibly take one more leg. But when we saw in May, for example, that certain indicators started moving back, we quickly, whatever cash we had kept for a larger fall, we ended up deploying it back between May and June. Okay, so that is something that, including on the stock portfolios that I manage. So that is something that sort of we keep in mind, that basically the markets are leading indicators, and possibly after that you will see why, what happened, but it has sort of followed a normal cycle actually, and I think the most probable is that we are in early recovery phase, which is why, okay, when a lot of clients come back, and say, okay, this may be a time to book profits, we say yes, we need to manage risk and we will do that. But I held back from doing that for almost a couple of months, because I think that was sort of something that people were increasingly asking earlier as well, when we are we are closer to the peaks. Okay, and now that we have passed the peaks, also one expected one bit of a move before we see some bit of a correction there. So I think from a disciplined investing perspective, maybe some bit of phased one, but you still should stagger it out. And I'm just referring back to my last webinar, and one of my questions there was, do you want to make money by design or by flow? And I believe that actually you can make money by design even in volatile markets like equity markets. And for that, this was the summary slide that I had. You need to understand your risk profile, to diversify, maintain appropriate asset allocation, be a disciplined investor, dedicate time and effort, to managing your investments, overcome fear and greed. Because if you see, and if you step back from maybe what you felt during this downturn, markets tend to make you do the opposite of what you should be doing. Sort of fear comes in, when markets are, falling very, very sharply and possibly at the best times to invest. And at market peaks, the environment is all positive, all the information flow is positive, and you really feel like investing because you heard that somebody else made 100% return, or you yourself may have made 100% return in some other investment and think, yes, this is a very good investment avenue, let's put more. The other is about maintaining a long-term perspective. Okay, we need to look at it from the long term, and like I showed the chart, in the long-term markets, the phenomenal return, okay, which you can never even imagine. Okay, but where you keep the short term, you may see large volatility. Even this volatility that you see of almost like 40%, 50%, at very, very large market falls, they still get recovered and markets go back to its highs. Okay, invest in stocks if you have the inclination. I'm again, mentioning this because a lot of people have seen, mutual funds move up and down and think that, yeah, they've done a bad job. Let me try it myself. Yes, markets will give you success in the beginning, but I can tell you from looking at a lot of clients' portfolios, when the falls happen, retail investors' portfolios fall far, far higher and take away a lot of the gains, and possibly you end up in losses, there. So you need to invest in stocks yourself if you have the time, you have the inclination, to be able to, and also the ability. I looked at these aspects in that last webinar, so we can refer back to that, and if you want it, we can share it with you again. Okay, and the last is actually that you need to monitor your portfolio rigorously. This is again a quick one off the previous one, where my point was, markets falls are always opportunities. That is where the last time, when the markets had fallen right from March or February onwards, we were showing this chart saying that yes, don't worry, these are points to buy. And today also we've seen that actually that's exactly what has happened. Sort of right now, this ended up being a phenomenal opportunity to buy. Right. how do you rejig your portfolio? Okay, so coming back to what is it that maybe we can do ourselves to one's portfolio? Okay, so I guess there are two parts to it. One is, are you fully invested, or at least I know some people who are sitting in cash significantly. Okay, sitting in cash significantly is a very, very difficult situation to be right now. Okay, and even if you have liquidity now to invest, I still believe we may be in a relatively early stages, so it still may not be a bad time to invest. But you need to watch it and invest a little carefully and see if one can take advantage of any volatility that sort of comes in. But at times like these, it may be very frustrating because markets, every time you feel like investing, it will move up more and more and more and make you more and more nervous. And the only thing is sometimes what makes you frustrated and say, okay, let me invest, and it's probably the time that markets are ready to fall. So this is a difficult time for somebody who's sitting in cash at this point. But for somebody who's invested in equity, I think that's where the whole webinar is about. That is a question that has been repeatedly coming from our clients, okay, saying that is this the time to actually book profits and rejig the portfolio? So what should one do? One is, it's actually the end of the calendar year, maybe you're getting into vacation. This is a good time to actually look at it. And we also have some bit of initial confirmation of economic uptake, wherein actual parameters on the ground have all moved up in almost like a V-shaped curve. Okay, so that is very, very, not only markets, even the economic parameters have moved up very, very sharply, and that is sort of the first trigger of a confirmation, if I could say that, possibly we are in early stage of a cycle turn on the upside. Okay, and so we should see some reasonably strong economic growth and market performance is what we do expect. At the same time, okay, we have biases of, how we have, what are our experiences, right? So some of us may have experienced that, the large cap stocks have done extremely well, right? And if we continue to stay with those, markets actually end up changing their flavor. And I think that is something that we should see a bit of a change in cycles. And so one is large caps, I think, should move to mid and small caps in terms of growth. So for somebody who wants to be a little cautious and not just want to go in small caps, actually mid caps is not a bad place. You can also use multi caps. And so multi caps is a combination of large, mid, and small caps. Now, you also need to keep in mind that mid cap stocks are not necessarily very small. Though the name does convey it, the mid caps are for stocks which are between 101 in terms of market cap to 250. The first 100 are categorized as large caps. So 101 to 250 are categorized as mid caps. And earlier, if you remember, HDFC top 200, which means it took the top 200 stocks and it was still a large cap fund. So the regulators have been a little tighter in their definition, and mid caps are still very, very large and good, solid companies. So they are not, the very small ones. The small caps are where, the risk is higher and, the volatility can be higher. The other thing that we expect the change to happen is from growth. Growth has done extremely well in this period of time. Okay, and that's also because maybe interest rates have been lower. You found technology companies and all of them have done phenomenally well in the US and in all over the globe as well. Okay, and so that has been a very strong theme. I think that will change. It will change to value, which means people start looking for things which are value picks. Okay, so that is something which we can sort of look at. And possibly do for part of your portfolio. The other is, in terms of emerging markets, I think will begin to move. The last decade, actually, US did extremely well. I think US will slow down a little bit in terms of market growth, and emerging market will start moving up. In fact, for some of us who have currencies, foreign currency, education, etc., we think that the rupee will appreciate vis-a-vis the dollar. In fact, possibly against, and the dollar will depreciate versus most other currencies in this period is what the expectation is. Okay, so that is something which we can just keep in mind. So I think emerging markets, and that's where I expect continued flows to countries like India. In fact, I've been saying for maybe over a year or two that I think this decade will probably be the decade of India. So we need to be a little cautious, about exiting too early there. Now, the third thing is to look at, we think sectors will also rotate. Okay, so we need to just keep that in mind that we may see some bit of rotation in sectors. Some of the ones that did very well in the past may not do well. I think consumer has done extremely well in the past, but we need to see how far they continue to do. You need to write the gains, but book profits when certain indicators peak. So the philosophy that we follow is we try to look at least I try to look at numbers and indicators and not necessarily go by emotion and what one feels like. And so that there are triggers that we can start looking for, and whenever those triggers sort of come in, book regular profits. Phase buildup of gold is insurance in your portfolio. Insurance not for now. Okay, we already saw when the pandemic happened, gold also did extremely well. Okay, and in this phase of volatility, gold was one of the best assets before equity started moving back. So in periods when markets do badly, gold is your portfolio insurance. I'm saying again, gold is my portfolio insurance more because of what are the next couple of points. Okay, when I'm saying beware, when the cycle turns, okay, this time I would expect a 50% plus type of market fall. Okay, the last time we did see almost a 60-65% fall in 2008. Okay, so from the peak to the bottom, but here one thinks that again the cycle is going to be large and it's going to be sharp. And I think a reason for this is one believes that whatever has the pandemic has led to deterioration in the finances of various governments and also credit quality. And at some point of time, it will come and catch up. And whenever that blows up, it's going to be very large and it's really going to be possibly even frightening. Okay, so we need to be careful then, and that's where gold in such a time can be one safe haven, which we will sort of do very well. I've always maintained that I think that in this, in the long term, we'll see one phase where gold will move like how oil moved, from almost like $30 to it moved all the way up to 150 at some point of time. So I think gold will see a phase, and that phase is means that there's a whole lot of chaos there. So that's a long term and it's a big call that I have. Okay, but we should see possibly the up moves first, and those up moves can be reasonably large. So in summary, my point is it's great. It's a great opportunity to make supernormal returns, which means that in these next few years may give us phenomenal returns. Okay, but manage risk lest it remains on paper. And markets not necessarily follow a common cycle. While I'm sounding reasonably bullish, okay, the fact is, I will keep on, watching markets. And if a time comes that one needs to change views, one will change views and we change it fast. Okay, so which is what happened, like, when we expected markets to see one more low from the pandemic low. Okay, then, we kept around 20-25% of any fresh money that came in. Okay, and that's a period when we switched over and actually went back and completely deployed it. So similarly, on the opposite side, where we think that, it's time to look at the other side, markets, while it follows a larger economic cycle, I think the periods that there are not necessarily even in between them. So we need to be a little bit careful out there. And I'll just give you a case study of how, and this is what I was trying to say. Actually, the market has been relatively sideways for many people, and this is what we had done. So some of these are models that one was working on a live basis and testing. Okay, one of the things we are trying to see is how we can make execution more seamless, so that we're able to reach clients much more actively and at times reach across much faster and execute much faster, and be ready for potentially the next both up move, volatility, and potential down move. And this is how, typically, and this may not be a bad way to also start out, because if you see here, markets had gone up a little, you can, where somebody is coming in right now, you can, this is a period of, 2017, little past 2017 mid, when this client had came in. We invested mainly in debt. We invested in dynamic asset allocation, some systematic investments. Then we moved it to multi-cap. Okay. Interestingly here, the blue line, is basically the mid-cap index, and the red line is the large cap index. And you can see that in that period when the client came, the mid-caps were doing extremely well and continued to do well for some time. But we stayed away from it completely and sort of went to sort of large cap and dynamic asset allocation funds. But when after the next phase, we ended up looking more towards multi-cap, and slowly we, started looking at PMS schemes. Then we went into small caps at the next phase. And interestingly, the mid caps did not do well for another period of time, but subsequently, today, you'll find that that sort of has paid out significantly, because when the mid caps sort of moved, and that too, we were doing the mid caps through systematic investments. So that too, they were almost over 6 months to 1 year. So when that happened, as the market sort of moved, and including in the pandemic low, we were sort of able to look at it. We did give a bit of a profit booking, at a high. Okay, and we also, even on the low, we did come back and to all customers as well, and also we recommended a switch to from debt to equity, and this sort of can pay out. So the point I'm trying to make is we need to look at it at a broader level, and from the perspective of markets, we need to be changing our style, based on how overvalued, we think the market is. So at right now, I think it's a good time to, even if you are sitting in cash today, dynamic asset allocation funds, including in lump sum, are not a bad option to start with. Okay, you can, when markets sort of correct, then put larger money into mid caps and small caps as well. SIPs, STPs also are not a bad option to do, including mid and small cap SIPs at this point of time. So I wrote this book, Honey, I Lost All Our Money, and it's written in story form. And interestingly, we try to capture all market cycles, and this was what one captured here. These markets were on fire after a long time. The stocks and mutual funds that Sunil held had gone through the roof. Many stocks had gone up to the extent that Sunil became uncomfortable. Considering his past experiences, Sunil used to regularly sell his stocks as and when he felt that they had run up too much. The issue was that the price continued to go up significantly from where he had sold the stocks. So it's very much likely that whenever you book profits in this period of time, markets will make you feel really bad about it. It's like many of clients who sell their ESOPs, right? They never end up selling it at the peak. The reason is they've come out of a bad phase, they start selling early. Okay, then they end up continuing to sell. Every time they sell, they'll find that the price has gone up significantly more, and then they get frustrated and say, now this is a one-way street, it's only up, and they stay with it, and that's when they end up seeing that the value erodes significantly. So that was broadly from my side. Okay, I wanted to keep some time for your queries and to answer them. I'll be happy to answer your queries. Okay, and please do put it on the chat, and we'll be happy to answer them.